we have 20 minutes, I say. 20 minutes for Q&A, so let's go. Please start, and please make sure you turn on your light, your mic. Can you control it?
No, I can't.
We are mutually uncontrollable. Just ask anybody in the room. First is a hypothetical, and that is it strikes me that the equities market for the last many months has been inflated based largely on promises made, not yet delivered. In the event that Congress can't deliver on those promises, what do you see as the impact on the market and on the broader economy? And secondly, to the extent that our nation can be accused of having fiscal policy, I'm curious what your thoughts are on the implications of your projections for slow growth, 1.5%, 2% GDP growth, for government funding, federal government funding going forward. I'll keep the other three.
Okay, so those are, I think, really key questions. In terms of the stock market, again, the crystal ball theorem applies. It's very hard to predict stock prices. I think one factor that may be elevating stock prices relative to historical norms, and we tend to think of this as, PE ratios and things like that, is this very low interest rate environment. I mean, if you think about your investment portfolio, think about the choices you're making. You got stocks, bonds, real estate, other investments. Well, real estate prices are near all-time highs. Bond prices are near all-time highs in the sense that yields are low and the prices are high. Of course, the stock market's the same. So I think these are all interconnected in some way, with a very low interest rate environment globally, with Euro, the ECB, the Bank of Japan, and other central banks still got the pedal to the metal in terms of QE and keeping interest rates low. Even though the US is moving this direction, most of the world is still the other direction. I think that is pushing up equity prices and, quite honestly, real estate prices somewhat. So that, to me, is a kind of a normal functioning of markets. And as interest rates globally move up to this new normal, that put some downward pressure on equity prices. In terms of the fiscal policy, I mean, I think early on we saw in the stock market some separation between firms that thought that would benefit the most with certain reforms, say repatriation break for the big tech companies and things. I think now we see in the markets a degree of uncertainty about what's going to happen with corporate tax reform and some of these others. So I think it's still probably in the market. They're pricing it in with some probability of some tax reform, but we definitely have seen that come back. So if the tax reform doesn't happen, I'm not so, I think the markets are kind of prepared that that's one possibility that may or may not happen. But I would still argue that as long as we're in a very low interest rate environment, it's not surprising that cap rates are really low in commercial real estate. It's not surprising that PE ratios are very high. I mean, that kind of all goes together. So if interest rates do stay relatively low, like I was talking about, like if the 10-year Treasury moves up only to, say, 3.5%, that wouldn't put a lot of downward pressure on these other asset classes. Now, in terms of fiscal policy and low R-star, low growth rates, I mean, these are important factors in thinking about this. I try to stay very inside the lanes about monetary policy. I have this theory, which has been challenged quite a bit, that says if I don't talk about fiscal policy, Congress won't talk about monetary policy. But in this case, clearly, if you're at the CBO, if you're thinking seriously about if state and local government, about what's long-run trends in growth and income, in interest rates, these are important factors that need to be taken into account. Actually, the Congressional Budget Office and others have been bringing these estimates down lower. They're still a little bit higher than the numbers I said, but you're seeing this trend move to this to be realistic. And it is an important factor in thinking about how do you make both for state, local governments, for federal government, for pensions, how do you make this all add up? There's one in the back I saw right away, so.
Good morning, my name is Kenan Sprague. I'm an undergraduate student with the University of Akron. And my question for you is in regards to wage and productivity growth. So in a recent issue of Global Markets Daily, Goldman Sachs had said that they expect growth in wages to start catching up with growth in productivity and begin to close the gap that's existed since the early 1980s. So I was wondering if you could comment on what you believe the impact that gap has had historically on inflation and what that means going forward.
Okay. That's a great question on a very difficult issue, which is trying to understand what's affecting wage growth versus inflation and all the different factors which you described, productivity, changes in labor markets, changes in product markets. So I do share the view that wage growth will pick up based on historical relationships. When you get unemployment down to this low, you're all competing for workers. You're all, I know we are. The market gets hot, you have to pay more, and you start seeing that. It's been a bit of a puzzle, maybe, that why hasn't wage growth picked up already? To some people, it's been a bit of a puzzle. Our models are not that surprised, or statistical models that look at wage growth, because what are the factors that determine wages? Well, one is unemployment, the tightness of the labor market. Well, remember, for the last 8 years, until about a year ago, unemployment was above kind of the natural rate or the normal rate. We had a lot of slack in the economy, underutilization of workers, so there was downward pressure on wages for years. The second factor is productivity growth is slow. Real wages tend to grow with productivity, so that's holding wage growth down. And the third factor, which again, I love to brag about my colleagues at the San Francisco Fed, they've highlighted what composition affects. What's happening now is we're bringing all these people in the labor market who either have very little job experience, maybe they've been out of the labor market for a few years or are young, and we're seeing this, all these retirees who have a huge amount of job experience, paid high wages, salaries, and they're retiring as the baby boomers retire. And that creates this tilt in wages. So the really experienced high wage people are retiring, they're going off and living their future lives, and the young workers tend to just make lower wages because they don't have as much experience. So that's a normal part of an economy. It's just right now, I think it's tilting wage growth to be lower in the data. So one way we try to get past this, we look at something called the Atlanta Fed does this wage tracker, and there we track actual people's wage. So like, how much did you make last year? How much did you make this year? Those wages are actually growing pretty strongly. That avoids this composition effect that I said about changing the mix of the people who are employed. So I do agree with the premise that wage growth will pick up, continue to pick up as the economy gets tightened, and that's one of the reasons inflation will pick up. It's, businesses, the biggest cost by far is labor cost, and that's one of those factors. What's harder to know is what's the new normal. I know I just talked about this. I got to come up with a new star variable, though. But what's the new normal about kind of what the relationship between wages, productivity, and prices? Because over long periods of time, our economy shifts around in terms of what that exact relationship is. And in fact, when we try to model this, those connections tend to change over time. So it's hard to know what the new normal there is, but something that a lot of economists have studied. Okay, so I got questions here. Alan. Now I'm nervous.
Yeah. Hi, Alan Berger, University of South Carolina. Very good talk. I really liked the fact that you were extemporaneous and didn't look at your notes very much. That was excellent.
Thank you, Alan.
I know you were looking for praise from me, but let me ask you. I want to go back to two of the things that you said and see if we can put them together. One is you said that long-term prospects for long-term growth are not so good because of demographics and productivity, and I certainly agree with that. And you also said that the Federal Reserve plays a big role in keeping the yield curve very flat, and I certainly agree with that. But I want to ask a question that pulls these things together. Is it possible that the flat yield curve is also responsible for the low productivity growth and for the low economic growth, in part because it's constricting the supply of credit? I know you want to keep rates low to increase the demand for credit, but if banks aren't going to be able to make money on these loans because the yield curve is so flat, maybe they're keeping the supply of credit down. Maybe that could be a factor.
So that's a very nuanced question about thinking about how all of these interplay. And I think the answer to your question, I think, which is something we have a lot of questions about what the new normal will look like in terms of the yield curve, but also how these kind of dynamics will play out. So I think we're going to have to watch. As we are thankfully the country moving interest rates back to normal levels. I expect over the next couple of years we're going to continue to raise interest rates gradually. We're going to normalize our balance sheet. So I guess as we get these, assuming these effects happen, how does that affect supply of credit? How does that affect banks? Willingness to lend and supply. So I think we're going to learn as we normalize the balance sheet, normalize policy. Do we see maybe some of these positive effects that you're talking about coming back? It's hard to know because so I've got this model of thinking about the neutral rate of interest that I tend to use. And what's striking about this is that it's 2017 Q2, so we have half of 2017 in the books in terms of data. We're not seeing any signs yet, at least in our models, in our data, that signs that the supply of credit is changing fundamentally or this net neutral interest rate is moving up. I mean, it could happen, and I'm definitely open to this, that over the next few years we're going to see movement back. But at the Fed, I'll just be honest, we've been telling the story of headwinds for years. That once we get through this period that of slow growth and low real interest rates, we're going to go back to something like the old normal. Maybe not exactly the old normal, but something like that. I've just given it up on that for now. That's why I say I have a 0.5% real funds rate, which puts me honestly, if you look at if you're a Fed watcher, that puts me at the pretty low end of my colleagues. Also, my views on growth tend to be relative to my colleagues. Again, looking at our economic projections, at the low end. And it's what bothers me is even today we're still not seeing any of these signs. But again, it could happen that we're seeing on the supply side changes that then mean that potential growth and the neutral interest rate do go up. Okay.
So I have a question about the intersection of monetary policy and fintech, and specifically the use of digital currencies. So some countries have talked about that, Sweden in particular, and one of the benefits has been that they've talked about is it's much easier to get to negative interest rates if you have a digital currency. So I'd be interested in your views on that.
So, I mean, it is a really fascinating topic, whether this issue of digital currency or even somehow having negative interest rates, that what some economists think of as deeply negative interest rates. So if you look at Switzerland, their interest that they pay on reserves is minus 75 basis points. So if you've been critical of the Fed for low interest rates, just think about being in Switzerland, okay? Sweden's the same, very low, and in the euro area, Japan's low. But there's a limit. You can't go to minus 3% because people can go to paper currency, and not take the hit on the negative interest rates. So definitely it's a topic that I think people in the fintech world are promoting and doing a lot of work on. And it's definitely a topic that's getting interest in the central bank community. Obviously, when you think about fintech, you think about digital currencies, you do go back to the oldest issues and some of the old issues of bank regulation. And one would obviously be money laundering, bank secrecy, and things like that. Is how do you have, with say a digital currency, how do you make sure that this isn't just a cheaper, better way to do fund crime or terrorism or something like that? You also have to think about potential for fraud and all of those various issues. So I think that there's ideas out there that are interesting. I tend to try to be open-minded. Right now, I don't think any of them, obviously none of them are being implemented. I do think, if you could, I personally think, this is my own view, that if there were a digital currency, the best way to do this would be as a central bank substitute for standard currency. Because I think a lot of these ideas of having private currencies like Bitcoin or things like that just have fundamental flaws. About when you have a currency, you want something that's safe, sound, that you trust, that will be taken. And a lot of these other ideas really have a lot of other negative effects. But again, this is an area I think we should be open-minded about. Probably the future is going to be including something about digital currency, but it's something for I think people are studying.
I was interested more in making it like the official, getting rid of paper currency.
Yeah. Well, that's what I'm saying. I think that the right model is really for a central bank to issue a digital currency. And then, of course, if you got rid, and I'm not saying we should or shouldn't do this, but then if you wanted deeply negative interest rates, you would either have to have currency, get rid of paper currency, or there are actually fancy ways to make paper currency basically to lose value over time that some people propose. We're running low on time, so there was a bunch of hands.
I am Kurt Knutson with Freedom Bank in Overland Park, Kansas. We're a $175 million community bank, started in 2006. What I'm hearing, Anchor, is capital is rising, returns are lowering, who wants to get into the community banking? Do you have any comments on that? We're at a community banking conference and
Yep.
you're not painting a very good picture.
No, I actually, I know that. I knew that coming here, and I think this gets back to return on equity. I mean, I think one of the topics I hear from community bankers in my district, so the 9 western states, is their boards, their shareholders want to get to an ROE like they used to have, and I'm thinking, okay, so the world's changing. We're a slower growth global economy. We're a lower real interest rate, lower return economy. We have to change that narrative. This is why I think it matters from a supervision. It matters from a bank point of view. I still think the community bank model, for all the reasons we know, it can be a successful model. It probably won't be having the same returns, and nobody's getting the same ROE in any investments as before. So I think we do need to turn this conversation away from let's get back to the party like it's 1999 to think about, well, what is this future? How does this future look? How do we be profitable in this world? Obviously, I didn't talk about regulation. I didn't talk about issues about cybersecurity, all the other issues, which are real challenges. But do that in a realistic way, because it's like pension funds. When I meet with the leaders of pension funds, and they literally ask me, hey, John, when are we going to get back to 8% yields? Because that's what I need to make this work. And I go, don't ever say that. I mean, that's not going to work. You can make this work, but it has to be in this, I think, in a different environment. That's why I talk about spreads. Go ahead.
Can I follow on
Yeah.
that just a little bit too? In October of 15, we were asked to model 6% up.
I knew.
And in January of 16, we were asked to model negative rates. So all of this is a little bit hard to follow.
Yeah, and I totally understand that. And
Damaged a little bit.
So I'm glad you asked, but I knew I was going to get this question because it's a good question. It's like, what? Hey, you at the Fed or FDIC, OCC, everybody, state regulators, you all been telling us to model higher rates, and we've been prepared for that. We've been not taking advantage of some opportunities in order to protect ourselves from interest rate risk. And of course, interest rates haven't gone up; they've even gone down. So I think that I understand that. I view all of that as about risk management and not about like where interest rates are most likely to be. So my talk is kind of the point forecast. And I think that the risk management is what happens if they go lower or what happens if they go higher. You need to be prepared. As you know, you need to be prepared.
I got that. And my last comment here, it just damages credibility when we hear +6 in October, and in January we hear negative rates. So we're going, do we have any idea what we're doing here?
Yes. We are being videotaped, right? Again, it's a fair question. I think that the narrative was worried about what happens if I agree that even today, this number, what I'm talking about, rates could go higher. We also have to be prepared for a rate environment if they could go lower. So I understand where you're coming from. It's like, well, one day you say this, the other day you say that. I think that from a risk management point of view, you got to be prepared for both of these. What I think is maybe a little unfortunate. We've been talking up this upside interest rate risk for so long that I think that this downside interest rate risk is one that you also need to be prepared for. I think you're going to get the last word.
I'm
No?
sorry. It just appears to me that what we're trying to do through monetary policy is stimulate seniors to spend their money because we come out of the workforce.
Well, but okay, so I will take. I mean, we were trying to stimulate the economy in the past because unemployment was high, inflation was low. We are moving in monetary policy, back to more normal levels, and I expect us to have finished this in the next 2 years in terms of short-term interest rates and the balance sheet. So I think right now we're trying to get out of trying to push the economy to spend more. We're trying to get back to just keep the economy on a sustainable, what I often have called Goldilocks economy, keep it growing. So I think the good news here, and it's a view that my parents share, is that we are getting out of the very low interest rates and getting back to a more normal rate. I think that, unfortunately, this reality that I've been talking about the new normal being lower, that isn't affected by the fact that we're normalizing. Of course, I think we'll just go back to normal. Well, thank you very much. This was really wonderful.